Hey everyone, a gray, dreary, rainy day here in South Carolina, so that's why I got to put on some spring garb because you got to have those vibes about the warmer weather and the sunshine coming back out. All right, I love solving financial problems. They're so much fun because all you're doing is putting a lot of different pieces to the puzzle together and you're trying to figure out how to make the best use of every dollar. So a big thing that's happening here over the last year is the Fed has raised interest rates as people who have variable lines of credit have a lot of decisions to make as to whether they continue making investments, pay down that debt, all kinds of unique circumstances, and everybody's is different. So let's just run through a recent example of a conversation I had with somebody, a guy who bought a piece of property a year ago, paid $100,000 for that property. So he put that $100,000 on his home equity line of credit. At the time, he had a teaser rate that was below the prime interest rate, so he was paying 2.75% interest. So last year, he paid $2,700.50 thereabouts, or $2,750, I should say, or thereabouts in interest on his home equity line of credit. So pretty simple move there. You're paying less than 3%, continue making your investments. But now all of a sudden, this year, rates are now, the prime rate is up to 7.5%. So that means that $100,000, if he's paying 7.5% this year, just paying the interest payments, he's going to be paying almost $5,000 more than he paid last year. So now the considerations are, at 7.5%, what do I do? Should I be more aggressive paying down this HELOC, or should I continue making investments? And here's where you have to start thinking about these things. By the way, this is exactly what the Fed wants. This is why they hike rates, because when you hike interest rates, you suck money out of the system. If you get more aggressive in paying down your debts, that's money that you're not spending on consumption, and that is money that's coming out of the system, and that's how you kind of get control of inflation. So this is certainly why the Fed keeps raising interest rates. Now the question is, from an individual standpoint, what do you do when rates are here at 7.5% and possibly going higher as the Fed continues hiking rates? You have to start thinking about what kinds of investments am I making? Do I have a long-term time horizon? Do I need a lot of cash? Can I invest in a more aggressive way? So let's say you're an equity investor. You want to put all your money in diversified stocks, the S&P 500, and you're hoping to get somewhere in the upper single digits, maybe 10% long-term rates of return. You're giving up 7.5% here on the loan. So a 10% rate of return is doing a little bit better than the loan, but you're also going to have to pay some taxes on the earnings on that money. So that's going to eat into your returns a little bit. So at this level, it's more of a wash in terms of if you think you can get a 10% rate of return and you got a 7.5%, 8% interest payment, you're looking at more of a wash. It can make more sense for a lot of people to be more aggressive paying down the debt. If you think, wow, I can get 12, 13% rates of return on my investments, now all of a sudden it maybe makes more sense to continue your investment strategy in the exact same way that you have been doing it. Conversely, if you're a moderate or conservative investor and you're aiming for more 5, 6, 7% rates of return, obviously now you're underwater compared to the interest rates that you're paying to service the debt. So if you're at 7.5%, 8% that you're having to pay to the bank in interest, and you're only getting 6, 7% from your investments, probably makes more sense to be even more aggressive in paying down that debt, because obviously as you're paying down debt that's at 7.5% or 8%, that's a 7.5%, 8% rate of return that you're getting on your money in that year. So this is the kind of way you have to think about knocking down debt versus continuing to make your investments. Everybody's situation is different. They're all unique, but it's all about how you kind of want to put the pieces together to make the best use of every one of your dollars.